Hi, I'm Jim Pierce with Baton Investing. Every day, people like you come to us whenever they realize that their current investment program just isn't working the way they would like for it to. We give them an easy-to-use system that has beaten the S&P 500 by 300% since 2003, takes about 30 seconds a month to use, and most importantly will help you achieve your financial dreams. Today is March 19th, 2015. And we're going to talk about a company called Qualcomm, which makes processing chips for smartphones and other portable computing devices. Now, Qualcomm earns a very high score of 91% from our investment strategy based on the fast grower methodology of Peter Lynch, the legendary former manager of the Fidelity Magellan Fund, who racked up one of the most impressive track records in the history of Wall Street. Lynch is famous for his PEG ratio. And that compares the price to earnings ratio of a company to the growth rate of its earnings over the past 5 years. And he would only buy a stock if its PEG ratio was less than 1.0, meaning that that company was able to grow its earnings at a faster rate than the market is valuing them. So he also looked at each of the individual components of the PEG ratio to make sure that this company wasn't growing too fast or growing too slow. And that's what we're going to go over today here with Qualcomm. So, name of the company is Qualcomm, symbol is QCOM, and again, the PEG ratio, which is PEG, is the price to earnings ratio, which right now for Qualcomm is a little under 15. It was 14.85 just a few minutes ago. And then it divides that into the rate of growth over the past 5 years in its earnings, which for Qualcomm is 23.4. So if you divide 14.85 into 23.4, you come up with a ratio of 0.63. Now this is a case where the lower the number, the better that is. And anything under 1 is considered good. Anything around 0.63 is considered very good. That means that, again, the company's growing earnings at an average rate of about 23%, but the market's only valuing them at a multiple of a little under 15. But in addition to that, if a company has more than $1 billion in sales, which Qualcomm does, then he wanted to make sure that the PE ratio wasn't too high, that the company wasn't being valued at such a high rate that it was inevitable that pretty soon it would take a hit. And he wanted to see a PE ratio of under 40. Well, in the case of Qualcomm, it's well under that at 14.85. And in the other half of the PEG ratio, the rate of growth in earnings over the past 5 years, he felt there was an ideal range of between 20 and 50% as an annual growth rate. And again, for Qualcomm, it's 23.4, which is actually down on the low end of that range. That's a more sustainable growth rate, say, than something that was up in the 40s. So not only does Qualcomm pass this PEG ratio test of being less than 1.0, it also passes his test of the PE ratio being less than 40 and the rate of growth in earnings being in that 20 to 50% range. So right now Qualcomm's trading around 70. Earlier this year it was up in the upper 70s. Then in late January they released their quarterly earnings report and mentioned that they were having some overheating issues with their Snapdragon processing chip that Samsung was going to use in its Galaxy S phone. So those sales have been put on hold until Qualcomm gets that overheating issue solved, which drove the price down. We look for entry points like that. We believe the company is going to solve that problem. So in order to keep investors in the stock, a couple weeks ago Qualcomm announced that it was raising its quarterly dividend from 42 cents a share to 48 cents. That's a 14% increase. And that means its dividend yield based on the future dividend is going to be about 2.7 based on this price of $70. If you look it up right now, you're going to see a trailing 12-month dividend yield of about 2.3 because they base it on what the company's actually paid instead of what they're going to pay. The other thing that Qualcomm announced a couple weeks ago is they're going to add about another $15 billion, another $13 billion to their stock repurchase program on top of the $2 billion that's left on the existing one. And $10 billion of that they're going to spend in the next 12 months. So that should add a lot of support to the share price. So it's an opportunity to buy in when stock price has been beaten down some, dividend yield is very high relative to the overall market, and again, it satisfies all of Lynch's important tests. Now, Qualcomm's only one of 10 stocks that we currently own in the Baton stock portfolio, and every month we go through this exercise with about 6,000 stocks that trade in the U.S. to identify the 10 that score the highest. So right now Qualcomm qualifies for that top 10. Next month we'll go through this exercise again. Even if it doesn't, that doesn't mean it's a bad stock or you should sell it. It just means that some other stock now is rated even a little bit higher. But again, we think right now it's a good buy up to 75. Now if you want to know more about how the baton system works, you can go to our website at batoninvesting.com and click on how it works. While you're there, you can also take a 3-question assessment questionnaire to determine if our approach to managing stocks is a good fit for you. We can only help a little less than half of the people that come to us, but maybe you're one of them. So go to batoninvesting.com now, and I'll see you again soon with another free stock tip. Thank you.